All right. Hello, everyone. I see people are starting to connect. We have a great presentation for you today. I'm going to give everybody a few minutes to get in here. And when I say that, about a minute or two for people to finish connecting, for those that are still trying to connect. And then once that time passes, we'll kick things off. So I appreciate everybody joining us today. And I appreciate the patience as well. About another minute or so. All right, that should be enough time. All right. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I'd like to thank you all for joining us for today's webinar, How to Vet an Investment Opportunity in 5 minutes with Catherine Monaco of One Street Capital. As a quick note, please be aware that Catherine will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's presentation is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information if you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction. Please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Catherine.
I am going to share my screen, so Will, it says it's going to stop yours, but
Perfect.
To start the presentation. Hi, everyone. Thank you so much for joining today. Good morning, good afternoon, depending on where you are. I wanted to talk to you today about, can you guys see my screen, Will?
Yep, looks good.
Great. I just wanted to start by, our presentation today is around how can you vet investment opportunities quickly, right? So we usually say 5 minutes or less. We're all very busy professionals. How can we make it something that we can look at a lot of opportunities, especially in the real estate space, which is where I play, and be able to weed through them very fast. But before I do, I just wanted to introduce myself and my company. So my name is Catherine Monaco. I'm a managing partner, founding partner at a firm called One Street Capital. We specialize in real estate investing, specifically in the multifamily space. And our real mandate and goal and why we were founded was to help investors, especially busy professionals, invest intelligently in real estate. So we like to educate, we like to make sure people know how to look at investment opportunities and what goes into our criteria. But also we just want to be able to do the work we do, the heavy lifting is to find, vet, analyze, and then ultimately acquire and run these investment opportunities for our investor base. Myself, I've been investing in real estate for over a decade at this point. I started in single family rentals and actually flipping houses as well before I transitioned to much larger multifamily projects. And I do all of our asset management and investment analysis. So I'm really familiar with the financial modeling and what goes into these investment opportunities, and then actually how that translates into operations as well on the asset management side. Make sure I have it that I can move. Okay, so first, when we talk about investing intelligently, and we will get into how you evaluate a deal, but I always like to start with knowing your personal investing goals. I think this is a step that a lot of people skip, myself included, when I was first starting investing, or even many years into investing. I think many people, they get their first W-2 job, they progress in their career, and they basically invest primarily through their 401k. They also may invest, in mutual funds or some stock portfolio mixes through a financial advisor, and then they really don't give it a second thought. And that's fine. That's normal. I think that's the route many people go, especially as life gets busier and busier. But the first area we like to tell people to consider is what really are your investment goals. And so some of the things we look at are cash flow versus velocity or returns on capital. And so cash flow is straightforward. It's the cash you get for the amount of money you put in. And so in real estate, a lot of deals will actually pay distributions to investors, and that counts as cash flow on the money that you've invested. When we talk about velocity or returns on capital, we're talking about how quickly you get your money back, how fast that grows, and therefore how quickly you can redeploy it into something else. A really great investment opportunity is going to have both cash flow and velocity of returns, but usually they're inverse. So the more cash flow you see, the slower the returns might be, or the slower the velocity of growth. Conversely, if you have really high velocity with high returns, you might see a lower cash flow and your cash might be tied up until you get it back. And so those tend to work in inverse ways. And for different periods of your life, you might want different things, or you might want to be balanced across those two. If you have a W-2 job and you're very happy in it and you're happy in your career and you're earlier in your investing horizon, you might be more focused on velocity of returns. Whereas if you're later in your career or you're looking to exit your W-2 job, you might be more interested in cash flow and something that can sort of pay the bills for your day to day. The other thing we like to look at is to determine the percentage allocation of your portfolio to real estate or just alternative assets in general. This is, in most people that we see, uh, people are usually very low allocations to anything other than stocks. And so when I said most people go into 401ks or stocks, that's what we mean. We're very under allocated in some other areas. And that actually leaves a lot of room for diversification within our overall investment portfolio. So again, understanding how much you want to allocate elsewhere or what you consider balanced is a really important question to ask. And then of course, your risk tolerance. Every deal is going to have different risks. For example, a ground up development, we generally consider a little bit riskier than an existing building that we're overtaking, but there can oftentimes be higher returns with that as well. And so again, just knowing where you fit, or if you want to be diversified in those types of projects and risk, really understanding what you're aiming at and what you're looking for, because that will help you determine if an investment opportunity is the right fit for what you're aiming at. And then finally, this is less about what your goals are, maybe, but collectively making sure you ensure and discuss and align with your significant other or your spouse or your partner. This is really important. We actually see usually we see one person become very interested in real estate, do a lot of self-education, get really interested in the alternative investment class, and kind of forget to bring their partner along with those financial discussions. We just recommend going hand in hand in that, because it does take time to get comfortable with a real estate investment or in general before you go even looking for a specific opportunity. But then when we start evaluating investment deals themselves, we always like to think of them in three pillars. And so we hammer this home with our central core tenet of our investment thesis is market, financial projections, and team. Market just means what are the market characteristics and making sure you're investing in the right places. We do know that there are plenty of markets that can provide really solid investment opportunities. So I do tell people not to get hung up on one specific market necessarily, but rather making sure the market has strong fundamentals and characteristics that meet their investment criteria and goals. Beyond that, that's sort of like the checkbox for markets. Then we have the financial projections of the specific deal itself. That's going to get into the specificity of the business plan and what we project the returns to be. And then we always talk about trust but verify. And we'll get into the specifics of this today on some levers that can really be pulled to manipulate those outputs and those investment projections. And then what I consider the most important is actually the team. So the sponsorship team, who's going to be operating the deal and who is the general partnership as well. I found that the ability to execute a business plan is far more important than necessarily the business plan itself. And so making sure you have a lot of confidence in the sponsorship team is probably the most crucial part of any investment deal. And we'll dive into all three of these today. So when we talk about markets, these are generally the criteria that we're looking at. So population growth, job growth, industry diversity. We don't want a market that's really heavily focused in just oil and gas or pharmaceuticals, for example, because if those industries take a big hit, we might see the market be disproportionately impacted. We want very solid diversity of industries. Supply and demand is another really important one that we saw come to light in the past 2 years. So if you take something like when you think of job growth and population growth, that really impacts demand. How much demand for housing is there going to be in the market? That's a great indicator. But you have to overlap that against supply as well. Something that we saw in markets recently is that there was a huge influx of supply. So even though there was really solid demand, there was an oversupply in the markets and rents were impacted. Phoenix is a really great example of this. Phoenix saw unprecedented rent growth in 2021, 2022, and the municipality was very favorable to new development. And so a lot of developers came in and sprung up these brand new, beautiful apartment complexes that really oversupplied the market and caused a lot of downward pressure on rents. So when we look at supply and demand in a market, it's really both sides of that coin have to be matched. And ultimately, in a market for an investor, you really want demand to outpace supply. And you want to be able to look currently and also, 2, 3, 5 years down the road for what that might look like as well. And then we always look at schools and crime rates. They give us a general understanding of tenant sentiment and renter sentiment in the area. All income levels are going to want good schools and low crime rates. And so we use that as an indicator of just market quality as well. There's other factors. There's probably 20 to 30 other factors that we personally look at, but these are the big ones that I think have the most impact on the quality characteristics of the market. And they really need to be in place and provide strong fundamentals if for us to even consider a deal in this space. And that's what we coach investors in as well. But of course, like you can say job growth, you can say population growth, you can say supply demand, but you really do want to have data behind that to back it up. And there's a lot of really great resources for investors that are free. You don't need to pay for databases. This is a list of some that we look at. If you're doing this professionally, like we do at One Street Capital, we have databases we also pay for. So we bring a lot of data to really analyze the markets behind those criteria that I described on the prior page. But even we still coach our limited partner investors and our investor clients to be comfortable with some of these free resources that they can just take a breeze as they start to identify a couple of markets that they may want to invest in. Okay, moving on to financial projections. This is where you really look at the meat and potatoes of the deal itself. And what we actually try to do and what we coach when you talk about, as I mentioned, busy professionals, how do you evaluate several deals at a time? How do you evaluate them against each other and really get the most bang for your buck time wise? We actually coach to find the ways to say no quickest, right? So weeding out deals is sometimes the easiest way to evaluate deals in general. And so the three things that we tend to look at, and again, in our own 5 minute, when we first get a deal or an opportunity, is the debt structure, preferred returns, and key assumptions. So debt structure is often overlooked. I think people go to the projections, preferred returns, and some of the key assumptions. But if you think about it, in any real estate deal, there's going to usually, I mean, I've never seen one without, let me put it that way, a hefty amount of senior debt on it. That's how these deals get done. It's good for investors because it actually increases projections. You don't want to bring 100% cash to a project, but it does mean the senior lender is a significant partner on the deal, and the debt structure is very important. So we do coach people to dive into the debt structure. And on the next page, I'll get into some of the red flags and kind of no's that we look for that help us weed things out. Preferred returns. So for us, number one, you need to make sure there is a preferred return on the project. If there's not, it's an easy no. There are plenty of opportunities right now that have preferred returns. What that means is that the investors get a certain first percentage of any returns on the deal. So we generally, in our deals, see that from anywhere from 7 to 9%. That's on a value add multifamily deal. That might be different on a development or otherwise. But the preferred return is really important because it makes sure that the investors' incentives are aligned to the partners' incentives, the general partnership. And so if there's not a preferred return, it's a red flag to me. And then there's some specifics about the actual overall return structure and how both groups get paid that are important to know as well. And then the third is the key assumptions. So these are things like what are the financial projections, but more importantly, what goes into those financial projections? Items such as rent, cap rates. Cap rates is an indicator of value. So what are you projected? The exit cap rates will be when the deal, when you go to exit the deal, and like I said, 3 to 7 years. Are there any refinance assumptions? What are the other thing I would say is time horizon is something that goes into these key assumptions. Those are the big ones, and I'll talk about them on the next page as well. But also looking at what are the expense ratios, what are the expense assumptions. I think on the key assumptions, there's a lot that you can dive into, and certainly before you actually make an investment and place capital, that's an area you should do a lot of asking questions on. But just for the point of doing a 5 minute evaluation, the biggest things are going to be rent, cap rates at exit, refinance, and time horizon. And I'll get into those as well. So, this is where I think the toolkit comes from being able to say no to deals quickly. And like I said, using these 3 pillars, here's the things that we're looking for, and we're coaching our investors to do the same. And you should be able to get all of these right out of the investment package that any deal has, right? So the first is the debt structure, looking at the loan to value. You really don't want anything north of 80%. There's some exceptions to that. I consider 80% high. Anywhere from 65 to 75% is a sweet spot. You don't want too little debt on the deal because then more equity has to be brought, and that can bring down investment returns, but you also don't want too many because that puts the deal, it limits your ability to have some downside fluctuation without the deal being in trouble. The other thing to look at is interest rate. So we will do floating interest rates. It's not a hard no for us, especially the past couple of years. It was one of the only ways to get deals done. But you do want to ask some additional questions if the interest rate is not fixed. So things like, do you have a rate cap in place to protect you from what happened last year when rates went crazy? Do you have interest rate reserves? Like, how are they planning around that floating rate cap is really important in a deal. And then also, what is the time horizon and how long is it going to take to get your initial investment back? This is, again, there's no real hard yes or no. It is a little bit of personal preference. But if it gets anywhere past, 7 to 10 years, you really have to understand, is it a cash flow play, which may justify that additional time horizon? And you actually don't want your money back necessarily anyways, because you just want to get the coupons from that deal. Or do you need your velocity mini? And that's where coming back to your personal investment goals really can matter, is what does the liquidity of this deal look like? Keeping in mind in real estate, especially, usually it's a very illiquid investment, meaning you don't have access to that capital once you've made the investment until the exit. When it comes to preferred return, I mentioned this already, but every deal should have a preferred return for its passive investors or its limited partners. You can hear those are the same thing, that they're used both ways. The preferred return really ensures that the lead operator's goals are aligned to the investors, as I mentioned. And then I generally like to avoid any sort of preferred return with a general partner catch up. So, what that means is a catch up means, okay, you can have the first 7% investor, but then in the next dollar, I'm actually, as a general partner, catching up to you. It just is a way to really actually ensure there's not really preferred returns. And so just something to be on the lookout for. There's enough high quality deals that have preferred returns with no catch up that personally, I don't think we should spend time looking at any that have those in place, unless there's really, really extenuating circumstances. And then the third pillar is really around key assumptions. And I mentioned some before, but these are the 4 that I go to immediately to look at a deal. One is the rent projections. Are they reasonable? Usually, an offering memorandum is going to have a comparable comp set slide, which shows other similar apartment complexes in the area, for example, and what those rents are today to inform what they believe the subject property can achieve. If those seem reasonable and the subject property is sort of in the middle of the road, that gives you confidence that they've probably been thoughtful. I will say, no matter what, those are going to paint sort of the rosiest picture in the offering memorandum. And so if in the investment package, the subject property is clearly the highest if in terms of rent projections in the comp set. That can sometimes be a red flag. You really want them not to be relying on being the highest in the market, because again, that's the most generous assumption. Um, I also like to look at the projection for the exit valuation when you're exiting or selling the property 5 years down the road. Um, what we'd like to see is the cap rate at exit is actually higher than today's current cap rate. What that indicates is that the deal is not relying on market appreciation, which is something that the operators do not control, for the deal to work. Certainly, we've done our market analysis and we hope the market will appreciate, but we don't want to rely on it because we'll never be able to perfectly time a real estate cycle. And so we always like to make sure that the cap rate is expanding or increasing over the life of the deal and the projections. And that's something they should show you or you can ask. Um, and then the third really big red flag or thing that we'll look out for is a refinance modeled into the projections. Refinance can be a really powerful tool. It certainly returns money to investors quicker and it helps accelerate returns. Those are all great things. But what we don't like to typically see is that in a promoted investment return or projected return is reliant on a refinance. So if you see something like this investment is projected to return 15% IRR, but it has a refinance in year 2, that inflates the IRR kind of artificially, because keep in mind, internal rate of return is a time-based calculation. And so if that is 15% because of the refinance, that gives me a little bit of pause. Like I said, certainly we would entertain a refinance, but we don't want a deal to be required or reliant or only work because of a refinance. And the reason is because we don't always control the ability to. We don't know what interest rates are going to do. We don't know what bank sentiment will be. We're not always able to guarantee a refinance in year 2 or year 3. So we always like to make sure for that. And then along those same lines, I touched on investment horizon, but if I have seen recently some investment packages that are marketing a 3-year hold. That's really going to inflate returns in that IRR metric as well. So if you're seeing like, oh, this deal has 15% IRR, but a 3-year horizon, well, a deal that has 15% IRR with a 5-year horizon is actually going to perform much differently if they end up exiting in the 3rd year. So that's one way that I've seen returns inflated. And just something to give pause. Generally, I usually see investment, and we certainly project ours around 5 years. It depends on the exit strategy, and it should reflect what the business plan is as well. If there really is an intent to exit in 3 years because it's a very fast value add project, that can be okay, but just know that that's going to be a big manipulator of the IRR that you're seeing as well. So always ask about the time horizon and know that it's a big lever. Generally for value add projects, 2 years is really fast value add. If you think about the fact that you're probably having to turn over an entire tenant base, that can take 1 to 2 years minimum because they have year-long leases, if not more. And so a 2 to 3 year exit is pretty fast. We did see it in the past couple of years, but again, really 2020 to 2023 was a very unprecedented real estate market. And so I don't like to rely on that as historical norms. And I think we'll see a return in these next 5 years to much more normal 5 to 7 year investment horizon. So just something to be looked out as you evaluate investment deals. And that third pillar we talked about is really about the sponsorship team. And I mentioned it again, I'll say it numerous times. I really believe the team and the operators are more important than the deal fundamentals itself. I have seen really great business plans not get executed because the sponsorship team just weren't great operators or didn't know what they were doing. And especially in the past few years, really anything 2015 beyond, real estate has been a very generous market. And I hate to say it, but it's made everybody look really brilliant. And now that we're going to be coming into a couple years, I think, of headwinds and some economic uncertainties, the sponsorship team's ability to stay organized, to execute, to see the big picture, and to focus on details is going to become really important. So these are all fair questions to ask and to get to know your sponsorship team. From Run Street Capital's perspective, we do a lot of pre-vetting with any partner that we will engage with. Right now, we're actually only working with 2 or 3 partners tops in any multifamily deal, because we like to be really, really comfortable, meet them in person, spend a lot of time, make sure we have shared values. And yes, that's at the professional sense. We do that full time, but I think it's also good for investors, and especially passive investors, to also spend some time getting to know their sponsorship team and getting really comfortable with them and making sure that they're aligned as well. But these are some specific questions can you ask. So at a minimum, we like to see at least one key principal on the team that has a decade of experience. That means they've seen it at least one market cycle and have kind of weathered the ups and the downs. How long have they been in business? How successful are they? What is their longevity? Again, give some sense to what have they seen and how have they handled adversity, because it will come. This big one around communicating with their investors is important. I would ask for sample investment packages or sample readouts for other deals. Ask how often you're receiving updates on the property and what those might look like, and ask for examples. You can tell a lot by those examples. I'm a big believer that how you do anything is how you do everything. And so, while you certainly can, you know, polish up an investor presentation or investor outreach in a way that maybe it's all flash and not substance, I do still think it indicates some quality, right? So if you're bringing something that is has really good executive communication, is very clear, is concise, is easy for investors to understand, is well polished, it does indicate that they, one, know what they're doing, and two, really care about the quality of their work that might translate into the rest of how they run their business. Likewise, if it's a really sloppy investor communication or with a lot of errors and mistakes, it doesn't necessarily 100% indicate that's how they operate, but it can be a red flag. And then also, how transparent are they? So ask a lot of questions. Will they share their underwriting projections? Will they share their model? What are their key assumptions that they made? The answers to those questions are very important, but also how they answer those questions is very important. Do they know the answers? Have they spent time with their financial projections? Do they know the levers or have someone on their team that does? Those are all really important. And then we also ask about performance. So track record, best performing deal and worst performing deal. The only thing about track record, as I mentioned, the past 5 years were really, really generous to operators and to real estate investors and firms. So I always like to take track record, especially in the past 5 years, as kind of a little bit of a grain of salt, because achieving 30%, 40% IRRs was usually could have been a reflection of market, which the operator has no impact on. And so when we had this like massive explosion of markets and rents in the past couple of years, like I said, everybody looked really, really smart. So definitely ask about the track record, but just take it with a little bit of grain of salt. This goes back to the longevity question. How long have they been in real estate? And then you can ask specifically about their best performing and worst performing deal, and how they handled the adversity of their worst performing. Again, failure isn't necessarily a huge red flag. It's just how they dealt with it and how they communicated to investors that you'll want to know. And then also, how long ago was it and what were the circumstances? We always, as myself personally, I'm placing personal capital, want to make sure somebody, a sponsorship team, is personally invested and they're involved in the project, that they're not just placing money and leaving. And then we ask about their investor retention rate. So this can be a really good indicator of how happy the investors are. Reinvestment is a really good indicator that investors are happy. Certainly, you can and should request to speak to one of their investors. That's more down the road if you're really heavily considering investing with this team. Not necessarily like that 5-minute analysis, but certainly a fair question as you go. And then, of course, fees. This is something we look at. So there are always fees associated with real estate deals. That's par for the course and very normal and expected. But one, they should be very transparent about the deal, about the fees that are charged. And any investor return should really be presented net of those fees, meaning those are returns after all the fees are collected. If I'm saying 15%, I mean after all fees, you are getting 15%. And I'm not trying to hide what that, manipulation might be or inflate the projections by not including fees. The biggest fee you'll typically see are acquisition fees on the front end that cover the cost of all that it takes to actually find and close deals. There's a lot of cost that goes into that. And they're anywhere, depending on deal size, from 2 to 4%. But again, a sponsorship team should be transparent. They should not be trying to hide any of those from you. So that's really it. I mean, the summary is just know your investment goals, know the 3 pillars that you're looking at, and know your criteria for saying no. That's really going to be the fastest, best way to weed through deals and to be able to evaluate things quickly. So I will stop there for questions, Will.
Okay, perfect. Thank you for all the great information so far. So yeah, as we said in the beginning of the presentation, if you have any questions, now's the time to use the chat and or Q&A function to ask them now while we have Catherine's time. So don't be shy. Type your questions now and we'll see if we can get those answered.
Yeah,
While
and while those go ahead. I will just
sorry,
also say, well, while those are coming in, we are really we almost consider ourselves an education firm first. Like, yes, we're an investment firm, but we love educating our investors as well and making sure so we kind of nerd out on this stuff. So if you think of a question later, please email me. You can find our contact information on our website as well. And we are super even for like the newest new investor, we love those questions. So please don't hesitate to reach out.
great, thank you. And just while people are potentially typing their questions in now, I guess I have a question. If what's the most common mistake you see a first time investor, at least a first time investor into alternative investments, make when they're getting started in the vetting process?
I actually think the biggest mistake they make is they stay fearful, right? So education is power. It's gonna feel a little scary or fear-based the first time you make an investment. What we generally recommend is, one, ask a lot of questions, get educated. We have a lot of resources that we recommend, but also it's okay to do a test investment. It's okay to do a smaller investment that I don't want to say that, if worst came to worst and you completely lost it because the operator was not good or the partnership wasn't a fit, that it would not derail your investment horizon or financial picture. That's how I got started. I did a lot of smaller investments with several groups. Then I really honed in on where this was when I was a passive investor, where I wanted to place more capital and who I really trusted. So I would say feel very comfortable asking for a lower investment amount, especially on a first deal.
That's great. Thank you for that. We do have a question that came in. It's actually a two-part question. The first question is current investment trends and impacts with today's interest rates and project rates. Are there any comments or projects rates, excuse me. Are there any comments you have to make on that?
So I don't know what the specific question is, but I'll try to answer it anyways around investment trends. So what we saw in 2023 is transaction volumes across the board in real estate dropped. Sellers didn't necessarily have to sell yet, and buyers, because of the higher interest rate environment, couldn't bring the asking prices that sellers were. And so there was this little bit of a holdout as buyers and sellers just really couldn't find their middle. And we didn't see a lot of transactions in 2023. What's starting to happen in 2024, at least in the multifamily space, is you are starting to see early signs of that distress that we've been talking about for a while. What that's usually coming from is variable floating rate bridge loans that were put in place 2 to 3 years ago and are coming due and not able to get extended. So they may have weathered the storm of the high interest rate environment, whether they had a rate cap in place or some good capital reserves. But they're getting to the point where they actually can't refinance in a way that makes sense. And so they're starting to sell and being a little more favorable to buyer prices that can match the current interest rate environment. And then on the buyer side, we're actually also seeing lenders and banks coming down with their own interest rates and returning to fixed rate product that's reasonable and can make deals work. So happy to answer it more.
Great. Thank you for that. And if there's more clarification that's needed, I'm sure they'll be able to ask. The second part was what preferences demanded by tenants are current trends and the cost to investors slash developers.
What preferences demanded my tenants? I don't think we've seen a ton of change in tenant preferences. So we have seen a shift to more house sharing. So there are people either cohabitating more, and that's impacting sometimes either occupancy rates or demand for one bedrooms has dropped. It's very, very specific to the market, though, and always something we look at. I also think that as I mentioned this in Phoenix specifically, but it's happening in a lot of those faster growth markets. There's a lot of new developments on the market that have just come online even in the past 12 to 24 months. Beautiful new builds. And usually those stand in like sort of a luxury class A asset class itself. But because the cost of those developments and holding those developments in particular went much higher with interest rates, so developers borrowed money to build these projects, and then the interest rate skyrocketed. Usually, the development rate is on a variable floating construction loan. So the cost to hold those projects really jumped for developers in the past 12 to 24 months. And so what we've seen is developers that are holding these projects cut rents and just try to get leased up as fast as possible so they can sell them and get them off their books. And so that's really impacted rents in these hyper local markets. Sorry, I want to make sure I'm answering the right question. And so tenants, as these rents drop, tenants who maybe are they're getting used to having access to more luxury, higher class amenities. And I'm interested to see how that plays out if rents sort of rebound. I think it's nice to, have those access to those things. But it certainly is going to depend on the asset class. And then also when rents rebound, the value, the value of a tenant dollar is going to be what it is. So we'll see what the preference is. But right now, there is an expectation for those higher amenities because they can get them for lower rents.
Great information. Thanks for the in-depth answer for both of those questions. Thanks for the questions, Peter. Another more so of a statement came in, and if you have any comments on these, please add them. But I see this coming a lot, of course, working on the IRA portion of it. Really talking about there are so many opinions on how UBIT and UDFI actually work. It seems very few actually understand it. Your typical hometown CPA doesn't understand it. People who invest with IRA money really need clarity on this. And that's true. You really do need to find a tax professional that is familiar specifically with IRAs to have the best luck on them being able to have the insight on UBIT and UDFI. And for those of you who don't know, UBIT is unrelated business income tax. Sometimes it's called UBTI or unrelated business taxable income, and UDFI is kind of a subsection of that, which stands for unrelated debt financed income. UBIT is basically when the IRS thinks you're running a business out of your IRA. The two main things that trigger that, at least for what I've heard, and I said this in the beginning, I'm not a tax professional, but what I've heard from other tax professionals is, if you're flipping properties within an IRA, the IRS might look at that as inventory in and inventory out, saying you're running a business while you're flipping the property. But what the IRS's definition of a flip is, they'll most likely never say. Some people say if you hold it a year, you're okay. Some people, if you say if you only do this many a year, you're okay. But those people aren't the IRS. So definitely talk it over with your tax professional. The other way that UBIT is triggered, or the other example of UBIT getting triggered that I've heard is developing on undeveloped land. So if your IRA goes out and purchases a plot of land and decides to build a property on that plot of land, then that would trigger the UBIT tax. And then a quick note on UDFI, unrelated debt financed income. Your IRA can receive financing for a property or an investment it wants to make. Um, However, it's not through your traditional financing. It would have to be through a non-recourse loan. And if that financing is received, that could trigger UDFI as well. Most people that pay these taxes within their IRA, from what I've heard, are okay with it because they'd be paying taxes on it outside of the IRA and they're still using it to grow their retirement account quicker than they were with their other investment options. Um, and yeah, so if that does cross your plate when you're investing out of your IRA, you would just go to your tax professional and they would let you know how much you'd have to pay if it's triggered, and they would file Form 990T, send that into us, and then we'd sign on behalf of the IRA and send those funds to the IRS from the IRA um, on your behalf.
And well, that's a really detailed answer, far more than I could give. I'll say two more general things on that. In my own experience, just as an investor, and anybody on this call that's even considering or has a self-directed IRA is already far more advanced than most investors that, like I said, just put money into the stock market or 401k. So you're at least being thoughtful. But the difference between someone that can do your taxes and someone that can actually sit and help plan your tax strategy is there's a lot of daylight between those two people, and finding the right tax professional that really actually specializes in what I would say tax strategy, tax planning, has been game changing for me as an individual investor. It's very hard to find. You're absolutely correct. But the key word is tax strategist or tax strategy planning, and really how to minimize that tax bill. And those people should absolutely be able to talk UBIT and EDFI.
Absolutely. That's a great addition. Thank you for that. Um, I don't see any questions at the moment, but just to reiterate, if anybody has a question that comes in now, we'll be happy to answer it. But just to reiterate, if you're watching this recording in the future, or if a question crosses your mind after the presentation ends, and it applies to the information that Catherine has gifted us with today, feel free to use that contact information to reach out to Catherine in One Street Capital. If you have any questions about your IRA, your self-directed IRA, you want to get started, we always have representatives standing by ready to answer your questions, whether it be just IRA questions, distributions, contributions, or if you're ready to make your investment and you want to know what's needed out of us, we're more than happy to help with that. Um, I see another question from LS. I mean, specifically with syndication, they need to clarify it in advance. Yeah, definitely have your tax professional ready, and a lot of people, a lot of companies that do have UBIT or UDFI, probably have a tax professional they're working with too, and they'll be able to clarify a little bit more. Unfortunately, I'm not a tax professional and personally don't feel comfortable with going into that. I'm not an expert onto it, but if you want to reach out to us later, I may be able to pull up some information or get you in touch with people that may know a little bit more about it. It's not an endorsement of those people. It's just people way more qualified to answer those sort of questions. Unfortunately, I don't have those answers, but I appreciate the questions um, very much so. All right. Well, if that is all the questions, I appreciate everybody's time. I appreciate Catherine coming out and lending her time and all the information that she's provided us with today. And I hope you guys all have a great rest of your day.
Thanks, everyone.